Welcome to The Explainer. Today, we're going to become financial detectives. And our guide, none other than Pat Dorsey and his fantastic book, The 5 Rules for Successful Stock Investing. We're going to use his playbook to uncover the secrets that companies try to hide in their reports. So yeah, get ready. We're about to crack the case of financial fakery. So, let's kick things off with a big question, one that honestly trips up even the pros. Can a company that's reporting record profits actually be going broke? I mean, picture this. A company drops its quarterly report, right? The headlines are all glowing, they're talking about record earnings, Wall Street's loving it, the stock is just taking off. But what if that's all a mirage? What if underneath all that good news, the company is secretly bleeding cash and on a fast track to disaster? The answer? It's a massive, unequivocal yes. And I know, that sounds crazy, right? But that's the thing about modern accounting. Those profit numbers you see, they're often more art than science. They're based on rules that can be bent, shall we say. But here's the good news. The real story, the truth, it's always there. You just have to know where to look. And that's exactly what we're going to do today. We're going to give you the detective's toolkit you need to spot these red flags.
Okay, so here's our game plan. We're going to start with why earnings aren't everything. Then we'll follow the cash flow. That's key. We'll investigate inventory, scrutinize expenses, and question something called goodwill. And stick around, because at the very end, we're going to wrap it all up into a simple detective's checklist for you.
All right, rule number 1 of our investigation. This is the big one, the one that changes everything. Earnings are not the same as cash. Seriously, if you remember one thing, let it be this. There's a huge difference between the profit a company says it made on paper and the actual cold, hard cash that's hitting its bank account. Getting these two mixed up is probably the single biggest mistake an investor can make.
So why is this possible? It's all because of something called accrual accounting. Basically, the rules say a company can count a sale as earned the second it ships a product, not when it actually gets paid for it. Let me break it down. Imagine a company sells $1 million worth of stuff to a giant retailer. Boom! They get to write down $1 million in revenue right away. Their earnings look amazing. But that retailer might not actually pay them for 3 or 4 months. So on paper they look rich, but their bank account, it's got nothing. They're just holding an IOU.
And that massive gap between what's reported and what's real, that brings us to our first big clue as detectives. We've got to follow the cash flow. This is the absolute golden rule. You see, earnings can be a story, a narrative that management wants to sell you. But cash flow? Oh, cash flow doesn't lie. It's the unvarnished truth. A good detective always follows the money.
Think of it like this. Reported earnings are like a perfectly edited movie. Management can pick the best takes, add some special effects, and make everything look great. But operating cash flow, that's like the raw behind-the-scenes footage. It's just cash in, cash out. No spin, no fancy editing. It's so much harder to fake. So, if you see a company bragging about its amazing earnings, but its cash flow is flat or even going down, that's a massive red flag. It's like someone telling you they just got a huge raise, but they're asking to borrow money for lunch. It just doesn't add up.
And Pat Dorsey says it perfectly. At the end of the day, cash flow is what matters, not earnings. So here's what you do. This is your first real detective move. Pull up a company's financial statements. You're looking for 2 numbers. Net income, that's on the income statement, and cash flow from operations. Over time, those 2 numbers should basically move together. They should be in sync. If you see net income going to the moon while cash flow is stuck on the ground, you know you found a clue.
Okay, next up, we're leaving the spreadsheets behind for a minute and taking a field trip to the company's warehouse. Because our next clue isn't in the numbers, it's in the inventory. We're looking for a suspicious pileup of stuff that just isn't selling. This is where you can see a company's story run smack into reality. So check this out. This is a classic red flag. You see sales are going up by 5%. Okay, not bad. But look at inventory. It's ballooning by 25%. What does that tell you? It tells you they're making stuff way faster than people are buying it. All that inventory is just cash sitting in boxes collecting dust, and sooner or later that stuff becomes worthless and the company has to admit it. They have to take a massive write-off. And trust me, this is a real thing. Back in the day, Cisco had to write off, get this, $2.2 billion in inventory. Just poof, gone. Okay, for our next clue, we're diving into some real accounting shenanigans. This is where companies play a little shell game with their expenses. They try to make costs just disappear. It's a way for a company that's actually struggling to look like it's in great shape. And our job is to figure out which shell the P is under. And here's one of their favorite tricks, the one-time charge. So a company will have a bad year and they'll say, oh, we had this big one-time restructuring cost. Don't worry about it. It won't happen again. But then you look at the next year and oh, what's this? A special charge. And the year after that, an unusual charge. You see the pattern? If something happens every single year, it's not a one-time thing. It's just a normal cost of business that they're trying to sweep under the rug.
Here's another way they played the game. When a company has a cost, they can either expense it, which means it reduces their profit right now, or they can capitalize it, which means they pretend it's an asset and spread the cost over many years. It's the difference between buying groceries for the week, that's an expense, and buying a house, that's an asset. Some companies try to make their everyday costs look like they're buying a house. It makes their profits look way better today. A famous example was AOL back in the 90s. They spent a fortune on those marketing CDs. Instead of treating it like a normal advertising cost, they capitalized it, which massively inflated their profits. Eventually, the SEC caught on, but a lot of people got burned first.
All right, our last clue. This one is, well, it's a bit of a weird one. It's an asset that can be worth billions of dollars, but you can't see it, you can't touch it. It's called goodwill. And the scary part is it can disappear. Just vanish.
So what is this stuff? Okay, when one company buys another, they almost always pay way more than what the company's actual stuff, its factories, its cash, is worth. That extra money they pay, that gets slapped on the balance sheet as goodwill. Now, in theory, it's for things like the brand name or customer loyalty. But in reality, a lot of the time, it's just proof that the CEO got a little too excited and overpaid for the acquisition.
And that's why you have to be super skeptical when you see a company where goodwill is a huge chunk of its assets. I mean, think about it. That company isn't built on concrete things like buildings and machines. It's built on hope. The hope that the deal they made years ago was actually worth it. That's a shaky foundation. And if you're an investor, you're the one standing on it.
And yeah, that bet fails a lot. And when it does, that so-called asset can be wiped out in an instant. The most legendary flameout, of course, was the AOL-Time Warner merger. In 2003, they finally had to admit defeat and take what's called a goodwill impairment, which is just corporate speak for, wow, we messed up and paid way too much. They erased $45 billion, with a B, from their balance sheet. Just like that, shareholder money, gone.
So, we've gone through all the clues. We followed the cash, we checked the warehouse, we looked at the expense games, and we questioned that mysterious goodwill. We've done the detective work. Now, let's pull it all together into that checklist I promised you.
Here it is, your financial detective checklist. 5 simple questions to ask before you even think about investing. Number 1, are earnings and cash flow telling the same story? 2, is their inventory growing way faster than their sales? 3, are they constantly having these so-called one-time charges? 4, are they playing games by capitalizing their expenses? And 5, is goodwill a massive part of their assets? Seriously, just running through these 5 questions can save you from so much trouble. It'll help you dodge most of the financial games companies play. And that's a wrap on our investigation. At the end of the day, this is about more than just checking boxes. It's about training yourself to be skeptical, to look past the headlines and do your own thinking. You have to learn to trust your own analysis more than the market hype. The great investors Graham and Buffett said it best. If your reasoning is right, that's all you need to worry about. And this checklist, it's your first step to making sure your reasoning is rock solid. Thanks for joining me on The Explainer.